Welcome back to Commercial Property Club, our podcast, where we give valuable information when it comes to income producing property. But once again, we would always like to give deep informations to our fellow networks in the likes of physicians and pharmacists, as well as our dentists, nurses, as well as our high net worth professionals also out there. Learning how to build sustainable wealth through apartment investing out there. I'm your host today, Ola Ibiwoye. Today we'll be talking about one of the most exciting and maybe misunderstood value add strategy. I'll be right back. Grab your note as well as your pen. You will need to take down notes concerning this particular episode today. All right. Welcome back once again. This is your host here at Commercial Property Club Podcast. My name is Ola Ibiwoye. Today's topic is emerging market advantages, actually, in the likes of what I call why location-based value add is the new gold. Ever wonder why value add does not only centers on renovation but also to your location? Actually, sometimes value add strategies like location-based investing in emerging markets can be misunderstood. It's not all about, like I said, granite countertops. You value add things like fitness centers. Sometimes the most powerful driving forces when it comes to your returns is simply being early to the right neighborhood. That could prove to be the game changer for you when it comes to investing in a particular niche of apartment investing in a particular sub-market or sub-region. Value add is more than, like I said, renovation. It's always about market positioning sometimes. Now, let's talk about emerging market areas that would experience population growth, job growth in terms of creating new jobs, also to bringing in new infrastructure in terms of development, maybe new roads or new franchises entering the neighborhood or a certain region. Those are particularly what you want to refer to as emerging markets. Some emerging regions could be maybe an influx of particular raising of funds in terms of municipal raise that will inject developers or bring in business owners, startups into a particular region, may constitute or overwhelmingly bring in job growth, maybe new healthcare facilities, or perhaps educational facility hubs that would improve the population influx as well as the job growth in that particular area. That's normally what you will call emerging markets. Those are typical traits you want to look for. Things that could bring in job growth, population increase. Now, why does this matter? Just like the last time we were doing some comparable in terms of relating or illustrating as regards to seeing the same scenario you see in your apartment investments, you also see it too when it comes to your practices. Why these matter? Just like your practice out there, let's say for example as a physician you're looking at a long-term health trends. Just like investors must look at long-term neighborhood fundamentals also too, just to see what's gonna happen. Think about an emerging submarket as maybe a medical breakthrough. At first, only specialists will recognize its potential when it comes to when medical breakthroughs. Only specific echelons of medical practitioners will look at the potential. which we would normally refer to as early adopters into these benefits, they are the one that will benefit most because they are the early adopters of this particular breakthrough. And by the time it's mainstream, the cost of entering into something like this would obviously be up there in terms of skyrocketing up there. Now, let's look at it in the light of apartment investing. For example, if you buy into a neighborhood before a new hospital, maybe a tech park, or a university expansion is completed, maybe bringing in huge upside in terms of economic development in that area, and you buy into that area before all this happens, let's say 120 unit property that probably overlooks a suburb near a new medical district, let's say, for example, and you rent out an acquisition of about $950 per unit. Within 3 years, let's say within that space of time, no hospital opens in that area, like a big facility, medical facility opens in that area. Obviously, maybe they bring a ton of job growth into that area, maybe in the tune of about a few hundreds or thousands. And let's say maybe there are influx of strips of retail following in that pattern. Obviously, lifestyle will become an upgrade in that particular region, and population increases, more demand will be obviously in the housing sector. So you're already in that neighborhood like 3 years before. Rents naturally will rise. Let's say your rent rises to about $1,250 per unit from the $950 that was previously the leasing price. Even before renovation, we're talking about before renovation, your net operating income would obviously jump to something in the likes of about $432,000 per year. Now, if you want to evaluate that at a cap rate of about 5%, you're having an additional of about $8.6 million in your value appreciation when it comes to your 150 units. Now, what's the key takeaway in this particular aspect of thing? Location tailwinds can multiply the impact of standard renovations. When you identify an emerging market, when you look at the location, maybe you've been in that location early enough before several economic development, increases the value of that region. Definitely, location counts in this aspect of things. Now, when you identify something like new healthcare facilities or maybe a biotech hub, maybe university or medical school expansion, the likes of your corporate relocation or logistic hubs, which can come into an area. An example of that in the Texas area is when Tesla moved into some parts of Austin. Their plant opened up in that area. Also, too, when you talk about the Dallas area, Morgan Chase is building a huge facility, a huge campus in downtown Dallas. Obviously, that would generate job growth. No doubt about that. Your infrastructure projects like your rail lines, your highways, and even building of airports, these are things that will add economic value to a region. Now, when you want to check for things like this to see the pattern of the percentage of your increase in population, there are several places you can visit online to find out what's really going on in terms of maybe population growth. Tools like Sensor Bureau, which can give you your sensor data job growth reports also too out there. There's so many of it out there. Also to zoning and developmental news that you can get from your municipal. Also to those are valuable resources that you can find out your trends of job growth, your trends of population increase. So let's look at it in something that we're familiar with. I've been comparing in terms of our practice setting, just like early disease detection saves lives, early market detection builds tons of fortune when it comes to apartment investing as an investor. So when you look at things in an holistic format in terms of when it comes to emerging market, your location being a value add proposition. As a passive investor, you're not expected to analyze maybe every sense or track, but you should know your sponsors' strategies. That's if you're a passive investor that have sponsors in place. Some of the questions you can ask them is, how is this submarket growing compared to the metro in average? That's if you want to compare with some other regions. You just want to see what kind of percentage you're working with, what kind of probability you're working with when it comes to the margins. Another question you can ask your sponsors, or rather you want to consider, is what's the new jobs, what are the infrastructures that are coming in that particular region that you've decided to invest with, either with a group or you're investing with other partners out there. Other questions you can also dive into vividly very well is, how has the rent growth been trending in the last couple of years, say 3 to 5 years span. You want to also ask questions about that, so as just to know the percentage increase in rental growth in that particular region that you're trying to see, that maybe this might be a gold mine for you in terms of getting in early. Also, your role is to sometimes evaluate whether your sponsor is placing bets where the wind is at their back or at their highest force. Now, you might also want to consider the risk associated with something like this is betting on growth that does not materialize. You know, when you project, when projects are delayed, employers relocating elsewhere, maybe sometimes maybe there's been a wind of news that a big company is relocating to that particular region, and for some reason they change their mind. That also too could be a risk, because even though you informed that there is something that will add value to that location, that particular thing that will add to job growth, they change their mind in relocating elsewhere. An example of that was what happened with Amazon. Amazon was going to go to New York, if I remember vividly, but because of the politicking, they relocated to somewhere else because New York would not do some certain things in which they wanted them to do. So obviously, the expectation of the developers out there that were expecting that there would be more job growth in that area obviously was disappointed. Now, what are the rewards of location in this aspect of value add? Exponential upside when it comes to growth. The backside of things would obviously result into exponential growth. As projects migrate, as the region improves, there's obviously backside growth. And what are the things that you need to take into consideration when it comes to mitigation? You want to look for multiple growth signals. You want to look at various titles so that you're not only banking on one set of titles. You have several that would say you have quite a number of it, not just one anchor project that you're looking at. You're looking at several other economic development in some several aspects of that region, so that you can be rest assured that indeed you found a very, very lucrative place that would obviously value add your investment. Sometimes even in downturns, people flock to markets with job opportunities and affordable rents. Sometimes it can be the case. So emerging sub-markets often outperform urban core during recession. I would say that because they offer value housing near new job growth. For physicians and professionals, these areas are like resilient medical therapies. They keep performing under stress, if you want to compare it in that light. So to recap what we've talked about today in terms of considering value add in location of emerging market, being early in an emerging market can be as powerful, if not more powerful, than maybe your standard renovations out there sometimes. For busy professionals that we communicate with, align yourself with the right sponsors who know how to read the market vital signs. The market titles knows how to go into resources and begin to forecast what it would be like in terms of reading a particular location, so that they could strategically invest well. In real estate, as in medicine, timing and location can mean the difference between ordinary and extraordinary outcomes. You will agree with me. The gold isn't always in what you had. It's often in where you plant your flags. So I hope I've been able to add value to you today on Commercial Property Club podcast. Don't forget to subscribe, leave a review with us, and share this with a colleague out there who's ready to invest smarter. Share this with people out there who are getting into investing in apartment newly. Until next time, keep your eyes on the market and keep building wealth through knowledge in apartment investing. I'm your host. Once again, my name is Ola Ibiwoye. Don't forget to subscribe, like I said, and also too, you can DM me. The email is gonna be on the screen. Just send me an email or connect with me on LinkedIn, Facebook, YouTube channel. Thank you. Have a super wonderful day.